Welcome to the midweek edition of Business Incorporated on Channels Television. I am BC Adebayo. Today on the program, World Economic says Nigeria's economy is gradually coming out of recession after 10 months of consecutive contraction. Plus, Burundi's inflation rate climbs to 20.7% year-on-year in February. And Kenya plans to roll out a mobile phone-based government bond this week. Now let's get the show started, and we'll begin with the markets here in Africa, where all the numbers are in the red at intraday, save for the Kenya index, which was 0.46% higher. The all-share index at the Nigerian Stock Exchange had lost 0.14% at intraday. The GSA index and the EGX 30 were also down 1.84% and 0.04% respectively. And in the Middle East, it's not any different, as the Abu Dhabi index, which was the top performer on Tuesday, retreated 0.69% at intraday, hit by profit taken in blue chips Alder Properties, which lost 1.7%, and Abu Dhabi Commercial Bank down 2.2%. Dubai's index fell 0.58%. In Qatar, the index fell 0.85% as some of the previous day's chief gainers retreated, and all but two of the 12 listed Saudi Arabian petrochemical makers also fell, dragging the main Saudi index 0.89% lower at intraday. European markets were also lower in early trade today as the head of France's central bank seeks for more ECB stimulus. Ulrich Bartz, DW TV Channels TV financial correspondent at the Frankfurt Stock Exchange, joins me now to talk more about the latest development at the European market. Well, the head of France's central bank is urging for more ECB stimulus, politely pushing back against concerns in Germany that the policy is too loose for the 19-country currency bloc. Does this collaborate with what the markets expect?
I think it collaborates with what the market expects from a central bank governor like François Villeroy de Galhau, who represents France, which has huge debt and which isn't all that reform-friendly so far. The German position is a different one, but the French central bank governor says that we need a lot of stimulus by the central bank still, because inflation is not up there yet, where the central bank would like to see it. And it's not, it can't get there of its own accord, and if it would, it wouldn't be a sustainable gain. So he is making a plea for ECB stimulus to continue, but he is saying that the intensity can be reduced gradually. That's still not the German point of view. Also, not just the Bundesbank head Jens Weidmann, but also many people here in the market believe that the ECB has gone too far, and it's going too far too long. And a lot of people are calling for the ECB to take this opportunity now to reduce basically very soon, because inflation has already reached in the Eurozone and especially in Germany that 2% mark, and in Germany it was over 2% recently. So what is the ECB stimulating there? It's basically helping politically weaker countries, especially in southern Europe.
A German shareholder advocates group today presented its list of stock market horror companies with the 50 worst performance among the major stocks. So tell us some of the highlights of that report.
I think the absolute highlight is the number one on this watchdog list. It's Singulis. It's not a company that a lot of people are familiar with, but it was once a shooting star in the market, and it's fallen on hard times. And in the past 3 years, the value of this stock has been reduced by, hold on to your hat, almost 98%. So that's almost a total wipeout for shareholders. And there are other companies there that are almost more shocking because they're big and important companies. 4 DAX members are among this list of 50 worst performers in the German stock market. Deutsche Bank, Commerzbank, the 2 biggest banks here in this country, and the 2 biggest utilities, RWE and E.ON, have lost within the past 3 years between 40 and 60% of their stock market value, the shareholders' money.
Well, Dutch paint and chemicals firm Akzo Nobel has rejected a sweetened 22.37 euro billion takeover proposal from U.S. rival PPG Industries, digging in its heels in a transatlantic standoff between the two industrial giants. Now, why would Akzo Nobel refuse such a sweet offer, and how's the market taking it?
I think the market is taking it basically in stride, or should, because what it means is that if Akzo Nobel doesn't accept this, well, then PPG pretty well has to make an even higher offer. It's already upped its offer from 83 euros to over 88 euros a share there, and it's an offer worth at the moment 21 billion euros. It is a sweet offer, but it's not sweet enough, Akzo Nobel says. And Akzo Nobel also says another reason for negating the offer is doubts that the cartel people would wave it through. And what does that mean? That means if the takeover were to go through, then some units might have to be spun off, which would reduce the attractiveness of the whole package, at least in the view of Akzo Nobel. And another reason Akzo Nobel says is it would hurt employees. An unusual argument because, of course, if it's a shareholders' value that you focus on, you're not focusing on as much as on the employee side. But it's good of the management to say that. Employees are always the ones worst hit by mergers. There's no merger or takeover which doesn't have a high and painful toll for employees in the end.
Thanks again, Orich, for those updates there. Orich Barth is DWTV Channels TV financial correspondent at the Frankfurt Stock Exchange. Well, let's take a look at the numbers coming from Wall Street, and it's all in the red amidst doubts that U.S. President Donald Trump may not be able to deliver campaign pledges to lower taxes and boost investment. The Dow Jones Index was around 0.2% lower this morning, while the S&P was 0.13% lower, while the Nasdaq slipped 0.14%. Japanese stocks sold off today, weighed by a stronger yen, and after an apparent North Korea missile test that reports said failed, the benchmark Nikkei 225 tumbled 2.13% at 19,041.38. Analysts reckoned the sell-off on the Nikkei was also spurred